If you want to beat inflation, there's a simple path. The path starts with you. It starts with you being exceptionally good at something. What are you good at? What is your superpower? Because if you got exceptionally good at that, you can beat inflation. You also need to understand what inflation is, how it works, and how to profit from it. And that's what we're going to talk about in this episode. I'm Chris Naugle, and this is What Now, What's Next. We have all embarked on a journey to fight inflation. You're fighting inflation. The government's trying to fight inflation. The Fed is on a rampage to destroy and get inflation down. But really, do we understand inflation?
I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted.
A lot of people, when they go out to the grocery store, they're out shopping, they say,
"Oh, this darn inflation. The price of things are so expensive. I remember back in the day, this cost X."
Folks, inflation is a hidden tax. It was created by the government and the Fed when they printed $5.1 trillion. Matter of fact, though, we have to go further back than just the pandemic when they printed all this money. We have to go back to probably the early 2000s, but specifically the Great Recession of 2008. They printed $900 billion to save the financial system, which they did. But in doing so, they began the process of creating inflation. Now, it didn't happen back then, but it's certainly prevalent now. They printed too much money this time, too fast, injected into the economy to solve the problem of, well, the problem they created. COVID shut everything down. They created massive fear. Businesses got closed. Businesses would have never survived, and many did not. And the government and the Fed answered back with a massive stimulus plan. The checks you received in the mail. If you had a business that suffered and you had employees, you got PPP loans that never needed to be paid back. If your business was suffering and you didn't have employees, you got EDIL loans, multiple rounds of EDIL loans. And those EDIL loans gave you money to run your business. But did everybody use all of that money, the stimulus checks, the PPP, the EDIL, to just improve their business? Some did, but some went out and bought goods and services. Some went out, wanted cars. They wanted bigger houses. They wanted to get out of the urban areas and get out into suburbia. All these things created demand. But that's just the front line. The demand and the supply that needed to fill the demand didn't correspond with one another. There was so much demand because there was so much new money, which is, when you print money, it's an inflationary creator. Money is not backed by gold like it used to be. So when they print a $100 bill, where does the value come from? Well, it comes from your current $100 bill. Your current $100 bill becomes worth a little bit less. The purchasing power of this $100 when they print $100 becomes less. Do that 5.1 trillion times. What does that make your current dollar worth? About that. The purchasing power of your money has been eroded. It's been taken away because new money has been put into circulation through modern monetary theory, which is an economic theory that basically saying when things get bad, we print money to fix the problems. That's not the exact meaning of it, but look it up. You see, when they print money, that money's got to go somewhere. So where does it go? Well, it goes in your hands. It goes in businesses' hands. It gets injected into Wall Street, the capital markets, the central banks. Everybody has more money. Everybody feels rich. Banks have more to lend. Matter of fact, when they did this, the banks couldn't lend the money fast enough. To pair that with one other thing that makes this deadly and makes inflation a real problem, which I don't know about 9.1% being a real problem, but it doesn't feel too good, does it?
I don't feel so good.
Keeping interest rates low for an extended period of time also stimulates demand. Demand for housing, demand for refinances, demand for cars and boats and planes and trains and everything else. I don't know about the trains, but you get the drift. When everything costs less to buy, we buy more expensive things. And when we buy more expensive things with weaker dollars, whether you're looking at this dollar or this dollar, you can start to see the problem. Demand requires supply. But when the whole world, for the most part, is shut down during the pandemic, supply suffers a little bit. And when the world started to open back up, it didn't happen just like that. It took some time. Different areas opened faster, other areas took longer. Other countries stayed in lockdown till just recently. All of this means there is not enough supply to fill the demand. So when you talk about inflation, it's a bit complicated right now because it is massive money printing, supply and demand, and yes, let's throw the Russia-Ukraine war into that. Because the Russia-Ukraine war is affecting supply of oil and wheat and other goods and services that we need in this country, which sends the whole thing into a spiral, landing right where we're at today, July of 2022. But who cares about inflation and your purchasing power and all that? You just want to live your life. But you are concerned about this, and you are on a mission to beat inflation. And how have you done with doing that? Because most people, when they think about inflation, here's what they think about. If my dollars are sitting in a bank account earning less than 1%, I'm losing the difference. If it's 9.1% and you make 1% on your savings account, you are losing 8.1%. That's not acceptable. You don't want to lose money. Cash is simply trash, as some of the pundits say. But it really isn't. But that's what they want you to believe. Because they want you to take your cash and go out there and put that money into assets. And where did those dollars go? Well, the first place we saw was the stock market. It drove a massive hockey stick, which basically means the stock market went straight up, and it drove asset prices up. It wasn't just you investing in stocks, bonds, mutual funds, and ETFs, but it was also the Fed investing. It was also institutions investing. When there's more money in the system, everybody throws money into the pool. And the pool was Wall Street. Not only Wall Street, but real estate. A lot of people decided to go off of Wall Street and they wanted to go onto Main Street, and that's the reason your house prices went up. But it wasn't your neighbors, your coworkers, your friends, and your family that were driving the price of real estate up. It was really the institutions. Because the institutions, the hedge funds of the world, knew something was coming. Because they understand the patterns, they understand the cycles, and they understand the signs better than most. So when they started slowly taking money out of Wall Street, they injected it into Main Street, which is why, if you are a real estate investor, a wholesaler specifically, your number one clients are what? Institutions, hedge funds. They're buying every one of the properties you can find at whatever price you want for that. Now that's a bit scary. If they're paying 10 to 20% over price, over the actual value of the property, for the houses in your neighborhood, you got to start asking questions. Why is this? Well, it's quite simple. They understand that a hard asset like real estate is going to outperform Wall Street. And they also understand Wall Street is due to take a plunge. Now this is back then. This is years ago they understood this. Ray Dalio talks about it. He talks about the patterns. He talks about productivity growth, the short-term and the long-term debt cycles. If you understood these and you're an institution, you understand what was coming. So therefore you had to pivot. That pivot was to Main Street. And that drove the price of your house up, which also drove a frenzy, a FOMO-driven frenzy. And FOMO, just so you know, is the fear of missing out. Nobody wanted to miss out on this newfound riches that you can get in Wall Street, and then this newfound riches you can get in real estate, so everybody jumped in. How's that working today? Well, your Wall Street portfolios, your 401ks, all those investments, well, they're anywhere between 20 to as much as 60% down, depending on what you invested in. How about real estate? Well, if you're in real estate, you're seeing softening across the country.
No, God! No, God, please, no! No!
Interest rates have been being risen a lot by the Fed. At 7 increases this year alone, that's going to affect the price of your real estate. Why? Because as the price of buying a house goes up because the interest rate's higher, the demand must come down simply because you can't afford the houses at those prices. Therefore, what's going to be the next step? The price of real estate is dropping. I'm seeing it already. Houses I could have sold for $330,000 not only maybe 6 months ago, are now selling for $290. And that's in Buffalo, New York. What about all those other highly appreciated areas? That's right. The price of real estate is coming down and will continue to go down as people's cost for buying that real estate goes up. So how do you beat inflation? It's quite simple. First, it starts with the understanding of it, which we just did the whole first part of this on teaching you what it is and how to understand what's going on. So how do you beat this? Well, somebody named Warren Buffett, which all of you should know, says, become the very best at something. Become exceptionally good at something. Because when you're thinking about inflation going up and the cost of everything going up, there is a big profit side of that. Because if you're on the side of supplying the goods and services that are going up, well, then you stand to actually be incredibly wealthy. Because if you're really good at something, you're going to be in high demand. When this whole thing lets loose, which we're already seeing the beginning signs of it, people are going to lose their jobs. There's going to be layoffs. You're already seeing big companies like Google, Apple, Netflix, Amazon. Maybe not so much Amazon right now, but you will see it as demand softens because the price of everything got so high, and as the Fed keeps taking action to tame this beast, this 9.1% inflation, you will see stock markets go down like they have, but they're going to go down a lot further. And you will see the economy start to soften, which means what? People get laid off. People lose their jobs. Corporations downsize. How does that affect you? Well, right now, the reason people are spending so much money going out there and buying, even though the cost of goods have gone up, even though to fill your tank is what? Something like 400% more than it was just a few short years ago? It's not slowing anybody down. Everybody's still out there. Travel is up. Hospitality's up. Even retail sales are still up. Why? Because you're still employed. Because we are still at low unemployment numbers. And as long as that paycheck's coming in, well, let's spend it because I don't want to keep any of these weak things. Cash is trash. Let's go buy assets. Let's buy things. Let's enjoy ourselves. Let's go out and eat. Let's go to restaurants because we haven't been able to do that for a couple of years. So if you're the entrepreneur that owns the restaurant and you have become exceptionally good at running that restaurant, you stand to make a lot of money. If you are the person that manufactures goods and services that people want to spend these weak dollars on, if you're exceptionally good at marketing, exceptionally good at sales, exceptionally good at manufacturing, exceptionally good at sourcing materials at a better price than your competitors, you stand to profit a whole bunch. But if you also become exceptionally good at understanding where we've been and where we're going, you can very easily see the opportunities that lie ahead. So all we need to do right now is become exceptionally good at what we do. Secondarily, forecast where we're going. Number 3, get super good at trimming your budget. Stop spending so much money. Do a household budget. Cut out the things you don't need. Get rid of those subscriptions that you don't even watch anymore because now you're not stuck at your house watching TV, playing video games. You can actually now go out into the world. So the things you were paying for because they were important during the times when we were in lockdown, maybe now aren't as important. Get rid of them. Cut the expenses. Become incredibly lean and don't forget to focus on your debts. During any recessionary period, the one thing that will tank businesses and individuals is debts. Because right now, the price of those debts is going up. Interest rates are going to continue to go up. Interest you pay on most of your debts goes up. And eventually, it will crush you. But let's go one step further. Eventually, your debts will crush you because those payments must be paid. If you lose your job, you can't make those payments. Game over. If we got inflation going up right now, and we got the Fed doing everything in their power to combat rising inflation with raising interest rates and unwinding their balance sheet and other actions, well, how do you profit from that? You find ways to make money that are sensitive to rising interest rates. Private lending is my choice. As interest rates go up, guess what else goes up? The cost to use my money. When I lend money out on real estate or whatever else I'm lending on, the cost for my money goes up. But maybe you don't want to be a private lender. Oh, that's too much work, which it's really not. You just mimic what the banks do, but let's just pretend. How about looking for investments that go up with inflation? Things like I-bonds, TIPS, Treasury Inflation Protected Securities. They just opened up a new auction for TIPS. And that auction was paying 9.62%. Does that beat inflation? Well, you bet your butt it does. And if inflation keeps going up every 6 months, those TIPS will increase. Inflation is temporary, not transitory, temporary. What goes up must come down. So what does that provide another opportunity for? Treasury bonds. When interest rates go up, the price of treasury bonds, specifically 10 and 30-year treasury bonds, the price goes down, creating an awesome buying opportunity. And when interest rates go the other direction, after they've created a recession, after they've crushed the economy, they're going to have to drop interest rates to stimulate growth. And when those interest rates come back down, what happens to the price of the bonds, which right now are going down? Well, that's right. The inverse happens. The price of bonds goes up. You must understand that if the price of things are going to go down, that will be the next phase. They're going up now, but what goes up must come down. When they come down, are you going to be ready to buy? Are you going to be ready to take advantage of these deflationary periods? We now understand what inflation is. We understand what drove it. We can probably start to look at where it's going to go. We might go up a little bit more for the duration of 2022, but after that, inflation is going to start coming down because the government is increasing the cost of everything. And on top of increasing the cost by raising interest rates, you know what else they're doing? They're taking liquidity out of the system. And out of the system means out of the banks, out of Wall Street. It's driving asset prices back down. And when things go down, you need to be ready to buy. It doesn't feel as good, it's scary, but that's what you need to do. You need to be ready, you need to be patient, you need to plan for this next phase. Because right now, you're picking up pennies, maybe nickels, and you're going to step over hundreds to pick up those pennies and nickels because you're rushing today to place these dollars, which you think are trash because they're getting weaker and weaker by inflation, but these dollars in the future will become gold because you will need these to take advantage of the decreasing prices. The news says this, you do that. You follow the leaders. You conform to what everybody else tells you to do. You don't create anything. Proactive is creation. Reactive is conformity. Which side do you want to be on? You want to be a creator or you want to be a conformer? I'll tell you something, the difference between success and failure comes down to one thing, and that's creation. Now, which side do you want to be on? Creation or conformity? So one of the most important things out of this entire thing is called control. Right here, right now, July 2022, the number one thing you need to do to beat inflation, to beat the declining markets, to take advantage of the opportunity that's coming is be in control. You need to be in control of your money, you need to be in control of your mind, you need to be in control of your lifestyle, your freedom, and everything that surrounds it. Check out this video right here, and that will teach you all about how to become your own bank by changing just one thing. I hope you enjoyed this episode of What Now? What's Next? My question to you is, what's your move? We'll see you on the next one.